Look, we need to talk. It is almost midnight. I am sitting here with my third cup of black coffee, and I am looking at the economic reality of May 2026. Let us be completely honest with each other for a second, because nobody else on your social media feed will tell you the truth. The stock market just had its first negative 1% day in almost 2 months, dropping 1.2% last Friday, and everyone is suddenly panicking. You are stressed out, you are watching the cost of living skyrocket, rent is eating up half of your paycheck, and the dream of building true financial freedom feels like a total joke. Oh shit, I get it, every single day. You see these suited financial gurus on television talking about macroeconomics, interest rate swaps, and complex technical charts, making it sound like you need a doctorate from Harvard just to protect your hard-earned money. Then you flip over to social media and see some 20-year-old kid standing in front of a rented Lamborghini telling you that you are a loser if you are not making $10,000 a week day trading. Random option contracts, it is a total circus, and it is designed to keep you confused, broke, and desperate. Here is the deal. Most of those people are completely full of garbage, and they are playing a dangerous game with your financial future. I am not here to lecture you because I am not a Wall Street analyst or a trust fund baby who started life with $1 million safety net. I am just a guy who was stuck in that exact same loop a few years ago, desperately trying to find a shortcut to financial freedom. Let me tell you about my own stupidity, because I made every single textbook mistake in the book back when I first started trying to invest. I thought the only way to get ahead was to swing for the fences. I took my tiny savings, money that I had worked 60 hours a week to earn, and I threw it directly into high-risk options and speculative trash stocks because some random guy on an internet forum said it was going to the moon. I woke up at 4 in the morning, staring at my phone with a racing heart, watching lines go up and down, feeling like an absolute genius when I made a few $100s, and feeling like vomiting when the market turned against me. One morning, I woke up, opened my account, and realized I had wiped out thousands of dollars in a matter of minutes. It was money that represented months of hard work, completely gone, evaporated into thin air because I was chasing a quick fix. That was my turning point. The moment I realized that trying to beat the system by gambling was a guaranteed way to stay poor forever. I had to completely tear down my mindset and rebuild it from scratch. I started ignoring the noise, stopped looking for the next hidden gem, and actually focused on understanding how real wealth is built over time. And guess what? It worked. I managed to grind my way from absolute zero to over $120,000 in net worth, not by hitting a lucky lottery ticket, but by becoming incredibly disciplined, boring, and consistent. That is why I call myself your wealth partner, because I am right here in the trenches with you, sharing the exact strategies that took me out of that stressful loop. Just last week, I shared with you that I started a position in MRAM, and while I expected it to take much longer, the position exploded by 160% within a single week as its market cap surged from $400 million to over $1 billion. I closed that position for a massive 160% profit, proving that when you follow specific technical indicators like the 9 and 21 exponential moving averages on structural build-out stocks, you can secure massive wins. Look at what happened with companies like AAOI, which went up 53% from that exact moving average indicator, or Lumentum Holdings, which jumped 21%, and Coherent doing the exact same thing. The trend is your friend until the very end, and you ride that momentum until it completely breaks. But as your wealth partner, I need to give you the real, unvarnished blueprint for what is coming next, because the broader market dynamics are shifting rapidly. Citibank and Goldman Sachs have been putting out massive warnings recently regarding severe tech hardware fatigue, and the data backs them up. We are coming up on a historically bearish time frame because from May to October in midterm election years, the broader market tends to experience an average correction of 10 to 12%. Now, our current year ends in a 6, and historically years like 1986 and 2006 actually bucked that trend and stayed positive. But that is a very small sample size to bet your entire life savings on. Furthermore, the Federal Reserve is undergoing a major leadership transition, with Jerome Powell named as chair pro tempore until Kevin Warsh is officially sworn in by Congress. Historically, the market loves to test a new Federal Reserve chair during their first few months in office, which almost always triggers a painful short-term pullback. On top of that, the geopolitical and trade situation is worsening by the day. The recent summit between the United States and China resulted in nothing but grandstanding, with China claiming a tentative agreement on airplane purchases while explicitly stating they will refuse to buy the new H200 artificial intelligence chips from NVIDIA because they simply do not need them. NVIDIA reports earnings this Wednesday after the close, and while they will likely beat revenue and net income expectations, the entire investing world is going to be hyper-focused on their forward guidance. Meanwhile, crude oil has been hovering above $101 a barrel for nearly 2 months due to the unresolved crisis in the Strait of Hormuz, where military tensions and deep-sea submarine threats are escalating. Historically, when oil sustains levels around $100 for months, an economic recession becomes almost guaranteed because it acts as a massive tax on the entire global consumer base. The inflationary chickens are already coming home to roost, with consumer price index inflation coming in at 3.8%, which is the highest level since May 2023. Core inflation rose to 2.8%, beating expectations expectations of 2.7%, but the absolute worst data point came from the Producer Price Index, which surged by a staggering 6% against expectations of 4.9%. Core producer prices hit 5.2% against expectations of 4.3%, reaching levels we have not seen since January 2023. With producer prices skyrocketing like this, the Federal Reserve will absolutely not be able to cut interest rates anytime soon, and the mathematical probability of a rate hike is now officially higher than a rate cut. This sticky inflation and high interest rate environment means that while the current artificial intelligence euphoria has a bit more runway, a massive, painful market correction is almost a certainty by the time we hit 2027. So, how do we actually win in this highly dangerous environment without losing our minds or erasing our life savings? We do it by becoming aggressively boring, taking profits on overextended hardware, and preparing for a massive sector rotation into software. We are already seeing early signs of this rotation as the software exchange-traded fund, ticker IGV, has quietly risen 25% since the 10th of April. Major software enterprises like ServiceNow are showing incredible fundamental metrics with linear growth in free cash flow, cash from operations, operating EBITDA, and total revenue that look almost too good to be true. Even Microsoft is looking like it wants to break out. And the recent news that Bill Gates sold the absolute remainder of his position is a complete non-issue because he sold the vast majority of his shares years ago, missing the entire pump to the mid-$500 range and costing himself a chance to become the world's first trillionaire. If the S&P 500 experiences a brief correction here after its massive 7-week win streak, you need to view that dip as an absolute gift rather than a reason to panic. To navigate this safely, you need to structure your core portfolio like a literal fortress. My personal philosophy and what worked for me to cross that $120,000 milestone is built on a very specific, unbreakable allocation framework. Think about allocating 70% of your long-term investment capital into a broad market index fund like VOO, which tracks the S&P 500. Why VO? Because it gives you a piece of the 500 largest, most consistently profitable corporations in the United States. When the dominant giants of global business make money, you make money, and you do not have to guess which individual hardware startup is going to survive the next decade because VO automatically filters the winners for you. Next, you allocate 20% into a high-quality dividend growth fund like SCHD. SCHD is your absolute secret weapon during periods of high inflation, rising producer prices, and macro volatility. It focuses exclusively on fundamentally sound companies with massive balance sheets and a long history of increasing their cash dividend payouts year after year. When the broader market goes sideways or takes a painful double-digit hit due to Federal Reserve uncertainty, those dividend checks keep rolling directly into your account, giving you cold, hard cash that you can automatically reinvest to buy more shares at a massive discount. It is the ultimate automated compound interest engine. Finally, you take the remaining 10% and put it into a growth-focused fund like VUG, or use it to take highly calculated, deeply researched tactical positions in individual growth stocks or specific sector plays like software or photonics. This 10% is your tactical allocation, your way to capture massive 160% swings like we just did with MRAM, without ever putting your entire financial foundation or your retirement at risk. If your individual growth positions take a sudden hit, your core foundation of VOAHED remains completely intact, collecting yield and compounding over time. Look, this strategy sounds simple because it is simple. But do not confuse simplicity with a lack of sophistication. The entire Wall Street financial industry wants you to believe that investing is an arcane, highly complex science so they can charge you exorbitant management fees to consistently underperform the market index. The real challenge is not understanding the basic math. The real challenge is mastering your own behavior, your patience, and your emotional state when the daily candles turn red. The absolute biggest edge you have as a young investor in 2026 is not some secret high-frequency trading algorithm. It is your time horizon and your willingness to live below your means. Living below your means is the ultimate cheat code for generational wealth generation. We live in a hyper-consumerist culture that is completely obsessed with looking wealthy. People are taking out massive high-interest debt to finance luxury vehicles. They cannot afford buying designer clothes on credit apps and blowing thousands of dollars every single month just to post a short video on social media to impress strangers. It is a massive, soul-crushing trap, and they are trading their literal lifetime financial freedom for a temporary fleeing illusion of social status. If you want to get truly rich, you have to be completely willing to look broke to people who are actually broke but pretending to be rich. You need to look at every single dollar you earn, not just as a piece of paper to be exchanged for consumer goods, but as a tiny worker that can be deployed into the market to go out and harvest more dollars for you. When you cut out the wasteful spending, ignore the overhyped asset bubbles, and automate your investments so that a fixed percentage of your income goes straight into your portfolio every single month. You are playing the financial game on veteran mode. That is what we call automated dollar cost averaging. You do not try to perfectly time the market top. You do not try to guess if tomorrow is going to be a red day or a green day based on raw emotion. If the market goes up, the total net worth of your portfolio expands. If the market drops significantly due to producer price inflation or a testing of the new Federal Reserve chair, you celebrate because your automated investment just picked up more shares of outstanding companies at a massive historical discount. You win either way. It takes away all the late-night stress, all the morning anxiety, and all the emotional mistakes that consistently wipe out 90% of retail investors. Look at the greatest investors in human history, the individuals who survive multiple brutal market cycles over decades. They do not day trade highly leveraged options. They do not read short-term charts frantically, and they certainly do not panic sell when the market has a bad week or a negative 1.2% day. They understand the long-term structural trajectory of human innovation, infrastructure expansion, and corporate profitability. When the broader market gets deeply fearful, when the headlines are screaming about an impending economic apocalypse and surging inflation data, that is exactly when the most massive wealth transfers in human history take place. The people who panic and sell their index funds at a lower level are handing their future wealth directly to the disciplined, calm investors who have the stomach to hold through the consolidation and keep accumulating. I want you to really process this because this is the core DNA of everything we build together. Wealth is not built by being the smartest or loudest person in the room. It is built by being the most disciplined and patient person in the room. Stop checking your brokerage account balance every 5 minutes. Stop listening to the hyperventilating talking heads on the corporate news who profit exclusively off your panic and clicks. Focus on increasing your primary career income. Keep your fundamental living expenses incredibly low. Take tactical profits when your individual positions hit overbought extremes. And aggressively feed the machine that is your core investment portfolio. The current economic environment might look intimidating with its narrow market breadth, surging producer prices, and international trade stalemates. But it is also a massive, unprecedented opportunity for our generation to build real long-term financial leverage. While everyone else is complaining, panicking over a single red day, or chasing highly leveraged speculative bubbles at the absolute peak of the hardware market, you and I are going to sit back, stay incredibly calm, and execute a proven allocation strategy day after day, month after month, and year after year. That is how I cross my milestone, and that is exactly how you are going to blast past your own financial goals. We are in this for the long haul, we are playing the long game, and we are going to win together. Alright, my black coffee is completely empty, and the sun is going to come up in a few hours. Keep your head clear, stay incredibly disciplined, ride the specific technical trends tightly, and let us go secure the financial future we actually deserve. I will see you in the next video.